some of my best buying years were within the recession period. So I was buying in 2009 and 10, unbelievable at prices of what I was able to buy at. And that really gave me the momentum to continue to build my portfolio. With regards to return, within a London portfolio, I'm getting between a 3 and a 5% yield, which is relatively good. If there's one thing I wish I'd bought more of, is HMOs, because the yields that HMOs are getting right now is very much in the mid-teens. Yes, the management cost and the management requirement is more, but you can systemize that and you can scale that up to really be able to make management of HMOs much easier. Again, using technology, using scale. But what's astonished me is the growth of the HMOs, which is unsurprising given that it's so difficult for first-time buyers to be able to get onto the property ladder and buy their own place, and it's easier for them to get into a very good quality HMO with great facilities. So that's been the surprising thing for me this decade is just the phenomenal pace of growth of HMOs, which are still a great investments to build and invest in.
Well, I guess I have to get both of you out of London and get you both into partnering with us in our HMO side of business, because the yields are definitely better. Yes, it's complicated, but as Nrinder, you said, at scale, our complication and our costs reduce crazily. So what maybe one landlord could potentially not do, 100 investors coming in together would be able to achieve at scale with our proposition. But that's a conversation for another day. In reality, I think even with Article 4 coming in pretty much every council nationwide, the possibility of having new HMOs is very negligible going forward. And we've been buying HMOs for the last 12 months. We'll continue to buy aggressively for the next 12 months as well. But at some point in time, you would not be able to convert any more existing properties into HMOs. Basis the drafts I have seen on Article 4. It's going to be very, very difficult. Moving on to our kind of the final leg of this conversation. So in summary, if someone asked you, what should I look for if I'm an absolutely new investor, I've got say 50K or 100K in cash, and I want to start my property investing journey today? And this question is to both of you, one by one. As a new investor, what should I look for? And what should I seek to achieve from that property investment? How should I build my portfolio based on your experience from the last 20 years?
So my experience has been to invest for the long term. So I've invested quite some time ago. I'm still investing for the long term, and I have invested in different types of properties. These are single lets, these are HMOs, increasingly larger sort of properties that I've bought and converted into smaller flats. But if you're looking to start off, I would look at what is an area that's going to work with you. Where do you feel most comfortable in terms of a long-term cash flow? We all know that obviously you can buy property at a much lower price in the north of the country, or the more north you go, the lower the price. But it's questionable of whether you get as much capital appreciation as you would in the south. However, what you're likely to do is to get a better yield based on the investment that you put in. So that's a consideration that I'd make. Is it how certain is the investment? Is there a great demand for rental property? Is that demand sustainable? Is that supported by local jobs, infrastructure, etc.? Is there going to be capital appreciation as well as a positive as well as a positive cash flow? But also, what would be ultimately what would be the exit? What would be the exit? When would you be looking to sell in the future and reap the rewards of your investment?
So Nrinder, just as a follow-up to that, you mentioned two words, long-term and exit. Now, how do you define long-term when you think about an exit? Is it like 10 years, 20 years, 30 years? Because predicting exit after 5 years is difficult, isn't it?
Yes. So I mean, I look at long term. it's I suppose the word long term means many different things to people depending on what age they're at.
Absolutely.
So for me, long term is very different from if I said long term in my mid-20s or early 30s. It's very different as to what I look at now. So I'm in my early 50s. And I look at long term as being something that will give me an amount of growth income for the next 15 years is where I look at, when is my retirement age, when is my exit, where I'll be looking to not work and reap the rewards of my hard work and my investments. So I'd look at a sort of a 10-year, maybe a 15-year long-term view. I think liquidity is also very important because we don't know where the market's going to be, but one thing we do know is that people will always invest in property.
So for you, long term is 10 to 15 years. Richard, what do you think?
On the long term thing, for me, I'm lucky or unlucky enough, whichever way you look at it, to be 38. So for me, it would still be sort of 20 to 30 years retirement, and then again, like you say, either exit by selling, so I've got lump sum, or just living off the investment and the increased rent. So yeah, for me, long term is that. I think I agree with a lot of what Nrinder says. I think what there is around now, which there wasn't when I started, and probably certainly not when you guys started, is the amount of information and education that you can do for yourself before you start to invest in anything. And Nrinder touched on things such as area, is there what the job's like, is it a commuter town, is it so that you fully understand the area. And I think there's so much that you can read about with regards to property investing, because like you say, more and more people are investing and continue to invest, that I think it can put you in quite a good position. And I think estate agents understand a little bit more now as well. And you can go in somewhere and ask questions and try and build that relationship with the agent, so that look, I'm buying my first property, but I intend to buy 2, 3, 4. Where would you start if you were me, sort of thing. And I think you can get all that education before you then start and decide which way you want to go with it. Do you want to do it fractional? Do you want to just go out, get your first little place, learn from your mistakes, and then move on to the next one, or stick with that one for a bit longer and then see how you want to do it. And again, it comes down to obviously the liquidity and what you've got. But yeah, I think that's certainly educating yourself is massive before you do anything, I think, at the moment.
That's great, gentlemen. We're coming to the end of our episode. I think the key takeaways or the summary from both Nrinder and Richard's experiences: look long-term, think about whether you want yields or whether you want a capital appreciation, or a little bit of both. Have an approach of long-term investing, I think, is the key. Understanding the market where you want to be, taking informed decisions, I think, is another key takeaway. And then do as much research as you want before you get in. Generally, property in the UK remains strong and will remain strong because of the structural shortage. If you see the January report from the Parliament, we are short of 4 million homes, and that's not a small number. I'm confident by the time those 4 million are built, we would still be short another 4, based on everyone growing up by then. So thanks a lot, gentlemen. Great concluding episode 1. Apologies for the video, and we'll make sure that in episode 2, we have our videos on. Until then, goodbye. Thank you.
Thank you very much. Cheers.
Great. Thank you.